Hi everyone, my name is Aini. Today I and my friends would like to share a topic about credit risk and market risk. As for my part, I will explain about what is credit risk and the types of credit risk. What is credit risk? Credit risk is the probability of a loss resulting from a borrower's failure to repay a loan or miss the obligations. In other words, credit risk can be defined as the potential that a borrower or counterparty will fail to meet their obligation in accordance with agreed terms and conditions. So here, the potential borrower or the potential customer who has the ability to pay, who can able to pay, they are not paying, they fails to pay, or they fails to meet its obligation in accordance with agreed terms. In simple terms, it is the probability of loss from a credit transaction. Losses can arise in number of circumstances. For example, when an insurance company fails to pay or fails to pay a compensation to a customer when it is due, when a consumer or business fails to pay the invoice rate when it's due, when a government bond issuer fails to pay or make a principal payment when it is due. Now there are three types of credit risk, which is credit default risk, concentration risk, and country risk. Credit default risk. Credit default risk is the possibility that a debtor or borrower will be unable to make or to meet interest or principal repayment obligations on their loan agreement. In other words, it means it is the risk that a lender takes on in chance that a borrower will be unable to make a required payment on their debt obligations. For example, the debtor gets 19 days time period to meet their obligation. However, the payment is due past 19 days, so it is considered as credit default risk. Second is concentration risk, particularly concentrate on a particular aspect. This risk will be associated with any single of exposure or a group of exposure with the potential to produce large enough of losses to threaten a bank's core operations. It may arise in the form of single name concentration or industry concentration. For example, concentration risk will occur when loans are susceptible to a specific sector of economy or business group that has slowed down, which is particularly risky to banks and financial institutions. The last one is country risk. Country risk is a possibility that a country will be unable to service or to repay its debts. Foreign lenders in a timely manner risk relating to dealing with other countries such as sovereign risk and political risk and others. In other words, country risk can also be defined as the risk of loss arising from a foreign currency payment or when it defaults on its obligations, so it's prominently associated with
Assalamualaikum warahmatullahi ta'ala wabarakatuh. My name is Muhamad Farid bin Muhammad Istaman from class DMK 6A. Today, I would like to talk about what is the market risk. Market risk is the risk that an investor faces due to the decrease in the market value of a financial product arising out of the factors that affect the world market. This risk often called systematic risk. This risk arises because of uncertainties in the economy, political environment, natural or human-made disasters. There are 4 types of market risk, which are equity price risk, foreign exchange risk, commodity price risk, and interest rate risk. Firstly, the equity price risk, which refers to the change in the stock prices in the financial products. As equity is more sensitive to any change in the economy, equity price risk is one of the most significant parts of the market risk. Secondly, foreign exchange risk arises because of the fluctuations in the exchange rates between the domestic currency and the foreign currency. Thirdly, commodity price risk arises because of the fluctuations in commodities such as crude, gold, and silver. However, unlike foreign exchange risk, commodity risk affect not only the multinational companies but also ordinary people like farmers, small business enterprises, commercial traders, exporters, and governments. Lastly, interest rate risk arises when the value of security might fall because of the increase and decrease in the prevailing and long-term interest rates. This risk can affect any market, including shares, commodities, and bonds.
Assalamualaikum warahmatullahi wabarakatuh. My name is Aizat Rahmat from DMK 6A. I would like to talk about disadvantages of market risk and credit risk. First, we go through to disadvantage of credit risk first. Disadvantage of credit risk has 3 points. First point is financial losses. There are quite a few different ways in which you may incur financial losses from bad credit risk management. For instance, the debtor you have lent money to might have become insolvent or might have filed for bankruptcy. Second point is credibility blows. Bad credits are going to impact your credibility. That's something that you should take into account. It is capable of creating a rather negative impression, which could lead to certain negative results. Third point or last point, shattered reputation. That's also something that you may want to take into account, especially when it comes to small enterprise. If you are reliant on the money from the credit repayments for certain obligation of your own and you fail to meet them as a result of bad risk credit management, your reputation is certainly going to suffer in result. Next, disadvantages of market risk. First point, we cannot completely ignore the market risk. It can only be hedged, which come with a cost and intensive calculation. An investor must be apt to understand what data to analyze and what data it should filter out. Second point, it is very prone to recession or cyclic changes in the economy. Since it affects the world market simultaneously, it is even more challenging to manage as the diversification will not help. Then we go through two differences between credit risk and market risk. First point for credit risk. Credit risk means the chances that you won't get all money back. For market risk means that the values of your investment can fluctuate. Second point for credit risk, relevant to interest-bearing investments such as mortgage, trust, and bank deposit. For market risk, relevant to property and shares. That's all from me, Muhamad, Aizat, Rahmat. Thank you.